Well, did you see what's happening to the U.S. dollar? Well, while everyone was out celebrating the 4th of July, the Congressional Budget Office back in Washington, D.C. was busy preparing their new numbers, their new predictions on what is going to happen with the U.S. dollar, how much in interest payments we will need to pay as a country on the amount of money that we're currently in debt, over $32 or $33 trillion in debt. So all of that debt comes with some pretty heavy interest payments. And it turns out, according to the CBO, I love how they released this report when no one's paying attention because everyone was enjoying 4th of July. The CBO numbers, the Congressional Budget Office numbers, show that already this year, we've spent $652 billion just on the interest on our debt. That means that by the end of the year, the projections from the CBO push it over $1 trillion just for the interest payments. Now, when you look at the amount of outlays from the U.S. government, how much we're spending on all of our services, we're talking Social Security, defense spending, all of those things. Now our interest payments on our debt exceeds all of that. And I love that this was buried on page 8 of the CBO report. By the way, page 1 of the new Congressional Budget Office report is even, it's equally astounding, but it shows that we increased our amount of spending in the United States by 15% from this year over last year. And the amount of revenue that we brought in this year over last year is down 9%. Those two things are not good. We're spending 15% more, hundreds of billions of dollars more, and we brought in less. And the value of the US dollar is being crushed. And the only way to continue to make these payments in a reasonable clip somehow is to devalue the US currency. So inflation is the way to keep these interest payments within some sort of a manageable degree that the Fed can make, or the U.S. Treasury can make. But I'm telling you, they're not going to be able to make them. So we are sitting on the verge of collapse here. And this is literally where we are right now in the United States. $32 to $33 trillion in debt. And the interest payments on that debt is expected to hit $1 trillion. And by the way, where do we get this money that we're borrowing? We get it from China. Yeah, we borrow this money from China, and also big international banks like JP Morgan Chase, which gets huge money from us on a regular basis, huge bailout money from us. And Bank of America, Wells Fargo, big international banks. So we are indebted to these big multinational international banks as well as China. And this is where we sit in the United States right now. So if you've got your money tied to U.S. currency, it's backed. If you've got your money tied to the U.S. dollar, you are in some, deep trouble. We need to really make sure that we are not putting this money in U.S. dollars anymore, guys. Making sure that you're buying hard assets. So today's our Q&A episode. We're going to get to your questions about investing here in a moment. But first, I want to tell you about our friends at Lear Capital, because Natalie and I are big investors in precious metals. Yes, we invest in real estate, but a big portion of our portfolio are in precious metals, gold and silver, because of what's happening to the US dollar. It's no secret, if you're tuned in, then you need to know that experts are predicting a big recession headed our way. One economist just said, this is the beginning of the end for the US dollar. So if your savings accounts are tied to the US dollar, look out, folks. Please protect yourselves. And we are devaluing the US dollar faster than ever before. And last year was terrible for most investors, but 2023, 2024 could even be worse unless you're smart and you have a portion of your assets in precious metals, other hard assets like gold, silver, and real estate. And that way you can protect your financial future as these other investments start to collapse all around other people. So if you want to invest in gold, our friends at Lear Capital can get you set up and start purchasing precious metals right now, or even converting part of your IRA or your 401k into a gold and silver IRA. It's very, very simple to do. And you can call them. They love talking to people on the phone, so you can see if it's a fit for you. Give them a call today at 1-800-450 1008. There's the number on your screen. We've also set up a special website just for you as well. You can get your free gold and silver investor guide by going to learmorris.com. That's LearMorris.com. And right now, if you call and work with them, they'll get you set up with $15,000 in free bonus metals. That's right, $15,000 in free bonus metals with a qualified purchase. Again, call their 800 number today, 1-800-450-1008. And you can buy gold bars, gold coins sent right to your home, silver coins, silver bars sent right to your home, or held in storage off-site. They will talk you through that entire process. Again, give them a call today, 1-800-450-1008. All right, so it is our Q&A episode day, and we've got 3 great questions from our audience. If you would love to ask us some questions here, please go to our website, go to morrisinvest.com, and click on the microphone icon on the right-hand side of your screen, and you can leave us a voice message there. Let us know what you'd like to ask us, and we will try to answer it here on the show. All right, our first question comes to us from Eric. Eric.
Good morning, Clayton. My name's Eric Clanton from Portland, Oregon. I have a quick question about the primary home that my wife and I are living in. It's worth approximately $450,000, and we were considering taking a first position HELOC to pay down the $140,000 we still owe on it, and use a portion of the equity to buy a new home. And with the home that we're living in now, we were thinking of renting that out to my son and daughter-in-law with a 1-year lease agreement for about $1,900 a month. Does this sound like it could be a good decision, or should we just sell our primary home and put down a portion on our new home? Question mark.
Thanks, Eric, for the great question. That's a prickly one. Because, again, I'm not a financial advisor. I can't tell you what to do with your family. But I will tell you that I'm just going to be honest here. It always gets a little prickly when you start like setting up lease agreements with family members. Okay, because all I say is if the numbers make sense and if it looks like it makes sense on paper, like the investment is a great investment, and you think that renting it out would make sense, absolutely go for it. If you feel like the numbers make sense, if your internal rate of return, if your rate of return is going to be good on this property. But it may make more sense because you've got a real diamond here of a property. It looks like it's mostly paid off. You could sell it and make a really nice, handsome profit if that's what you ultimately want to do. But if you're just going to keep the house because your son wants to live in it, you have to really ask yourself if that makes sense. You know, from a business perspective, you love your son, of course, you love your family, but does it make sense? Or would it make more sense for him to find something else to rent and not have to be tied to a lease agreement with you? So those are things that I think you should really take into consideration here. You know, try to remove the emotion from this situation. And then and really ask yourself, what if you were renting it to a random person? It's not your son. And imagine after 1 year, your son moves out. Who's going to move into that property? Will you be able to rent it for $1,900 or more? Maybe it's more, and you're just giving him a break and you're giving him a concession because he's your son. And would it rent for a higher amount? And does the ROI make sense? Again, in my career, in my years of investing, I've talked to many, many investors who've worked with our team. And one of the questions I would always ask them is because they would hold on to a property they had years ago. And they bought it. It was their first property they bought when they were married, and they've held on to it even though they moved away. They had a family, they grew, they've got kids now, so they don't live in that place anymore. They held on to it for the emotional value, but the numbers really didn't make sense, right? The house is actually worth more if they would have just sold it. The rent is not very good, and the taxes they're paying is very high. So actually, they're kind of upside down, but they held on to it for emotional reasons. And they'd ask me, well, what would you do if this was your house? I'd say, I'd sell it immediately. I call a realtor because the market is hot. I'm going to sell it, make a great profit, and I'll roll that property into another investment. I'll take those profits and roll it into another investment. And because you lived in this property for so many years, you're going to not get hit with the capital gains taxes on this in the way that you would that if you just bought it for like a year, you held it for a short time, right? You're going to get hit with those capital gains taxes on it. So what I would do personally is I would look to make sure that the numbers make sense. Removing the emotion from the scenario, making sure that I'm not, take the sun equation out of it and just look at it from a numbers perspective. How much can you get on the market for renting this property? And does it make more sense for you to take that profit and roll it into 3 investment properties? Take the profits and, buy the new home that you want. And then you've got leftover $200,000 or $150,000 in cash. Roll that into down payments on 3 investment properties. I always think of the properties that we do, at Morris Invest. And if you go to our website, you can book a call with our team. But most of those are going to be between $50,000 and $60,000 down payments. And then with financing on the rest. And these are new construction properties. So that's where my brain always thinks about it. I'm like, if I've got $150,000 to $200,000 in cash, well, why wouldn't I buy 3 rental properties with that and finance the rest and bring in that cash flow and increase my net worth based on that? So I just would really make sure the numbers make sense and really just try to remove the emotion from it, Eric, and really see if it makes sense for you. I love, to answer your question, I love a first lien HELOC, right? And using that to pay down your primary mortgage, that's great. But if you're doing it just, and your son is going to move into the property, why bother with the HELOC at the moment? I would take the HELOC and use it to invest in other properties and buy other things and let your son pay down the rest of that balance of that mortgage, just like any tenant would in a property that I would rent out, right? Because I'm building equity based on the fact that the tenant is renting it out from me. So I'm building equity and I'm allowing the tenant to pay it down. So I know it's the tenant in this situation is your family member, but nevertheless, why go further into debt on this property when you can use it in other ways? So I just would think differently about it, or just try not to think emotionally about it, and just make sure it makes the most sense for your son and for you. And in the long run, it's not just a 1-year investment, because you're going to blink and that 1 year will be over, right? So what does it look like 3 years from now? That's kind of where I would position things. But again, I love a first lien HELOC, but I would like to use that to invest in other things. To be able to buy additional properties. Remember, you can't eat equity. So if you move out of that property, now you've got equity in their property. How can you leverage that equity to buy additional rental properties? So, because a primary mortgage, living in a primary house is not an investment, right? It's not a performing asset. It's an asset, but it's not a performing asset. So just remember that. So thank you, Eric. Next one is Roderick, I believe.
Hello, my name is Roderick from Milton, Ontario, and I was wondering if there's a way that I can use my physical gold and silver that I've accumulated over the years to leverage it to purchase a property without actually getting rid of it and without actually trading it for fiat money again in order to purchase a property. Thank you very much. I'd appreciate your response.
Thanks, Roderick. Well, I would definitely talk to the companies that are holding your gold. If you've got different, where it depends on where you are based in jurisdictionally, to use this. But of course, a lot of investors will use their hard assets without selling it. And you'll be able to create loans against it. I know different gold companies that we work with and talk about will allow you to take out loans against your gold positions and give you that opportunity. So you don't have to sell the physical gold, right? I mean, the old story is that really smart investors aren't selling their Bitcoin. They're not selling their gold. They're not selling their homes, their assets. They're borrowing against them or borrowing against their businesses. But they're not selling the asset, in which case you get hit with massive profit capital gains taxes. So I would definitely talk to your different, the folks that are holding your gold. I don't know if you've acquired it and you're holding it for yourself in a storage, in your own vault, or you've got a company that you're working with. But again, I mentioned our friends at Lear Capital. Give them a call. I gave you the 800 number. earlier here. I'll give it to you again if you want to call our friends at Lear Capital. It's 1-800-450-1008. And they do gold and silver, of course, for us. That's one of our where Natalie and I do a lot of our gold and silver, and they're amazing. Call them. Just get on the phone with them, a free phone call, and ask them how you can borrow against your gold and get set up that way. So that's what I would do personally, is find a way that I could get loans against my hard assets without selling the hard assets itself, especially if gold and silver are projected to see record numbers. I mean, Bank of America out with projections on gold of like $2,500 an ounce. And it's right now at about 1,900. So, again, we could see huge explosion in profits and value for gold as we go forward. Thank you for that. Our next question comes to us. Julie, I think.
Hey, Clayton. I saw that somebody had asked the same question just recently, but I couldn't find where the answer is, or the video for it, or the audio. Since there's a looming recession that we're actually already in, is now a bad time to buy real estate? I have a lot of money that's been sitting in cash doing absolutely nothing, but I don't want to buy when the market is still hot in a lot of places, knowing that it's going to drop, and the potential for it being underwater is huge. So that is my question. Thanks, Clayton.
Thank you. Well, again, Julie, I can't tell you what to do with your money and where to do it and how, the sentiment. No one can really predict what's going to happen in the market. No one can time the market. But to me, the answer is always in real estate is always time in the market. So again, no one can time the market. Not even AI can time the market. Not even the best of people can time the market, right? But it's important to remember that it's time in the market that is the most important. So if I was sitting on a lot of cash, which is exactly what Natalie and I were just recently discussing and doing, is moving it into different pieces of real estate right now. Because I don't want to be in cash. I don't want to be in US dollars. Whatever I can do to be avoiding US dollars is where I want to be. And to me, owning hard assets, hard real estate assets in the best, most landlord-friendly rental markets in the country has always been great for me. Now, when you talk about hot markets, I'm just curious where the hot markets are right now, because we literally had a report last week that said real estate has just hit bottom, right? So now, if you were in these hot bubble markets like Boise, Idaho, and Las Vegas, and those types of places, right? Those areas, of course, if they've hit bottom, they've been down, 15% in value, 17% in value. Some of these are more retail markets where I would never invest in, okay? Then these are areas that I would want to avoid. I don't invest in those areas. But areas where I do invest, we haven't seen crazy swings of prices because they're boring, quite honestly. They're boring rental markets. And where I invest in Texas and other places, they're not flashy. They're not Miami. They're not San Francisco. They are salt of the earth, multiple job markets, healthcare industry, automobile industry, oil industry, low crime, expanding population, low taxes, great school districts. I invest in those areas. So those haven't been like hot markets. Prices have dropped a little bit, but they've moderated. So to me, that's where I invest. So Julie, if you want to, like I said, book a call with our team, we can talk you through that and kind of point you in the right direction, and give you a sense of what we see in the market and where we're seeing some of these different numbers right now. But as interest rates begin to drop, we're going to see the floodgates open on all these millennials that couldn't get mortgages and who sat back and waited. You're going to see an explosion of demand for more property. Right now, we have an absolute huge, massive demand for real estate in the United States. Okay, we need over 5 to 6 million properties to be built, and we don't have them. So there's an unbelievable pent-up demand for real estate. Again, I can't tell you what to do. I'm just saying I think it's incredibly important to own hard assets right now. Real estate, gold, and silver, like those hard assets, actual physical items that are not given over to the US dollar. They're not driven by, U.S. dollar devaluation. So I would just consider that. And when you look at these hot markets versus bubble markets versus rental markets, always really be aware of what you're seeing when you watch like a CNN piece or a CNBC piece when they're like telling you that real estate prices have dropped considerably. A lot of times what they're talking about is in these overpriced retail markets, Boise, Salt Lake City, those types of places. So please pay attention. Please pay attention to that. Okay, folks. Thank you guys so much for subscribing and being a part of the podcast. I really, really appreciate it. Thank you for tuning in and learning about your financial freedom. If you'd like to download our financial freedom cheat sheet, it's totally free. Just go to morrisinvest.com/freedom. It's a 3-page PDF that you can download, and I would encourage all of you to do it. It could change your life. Thanks, guys. We'll see you next time.